Everyone's looking for fireworks, but real investors, they chase the quiet wins. Right now, yields are the highest we've seen in a decade, while prices sit flat and the herd stays distracted. That's the setup the smart money waits for. To unpack the under-the-radar window, we've brought back our resident economic sniper, Kelvin Davidson from Cotality, to break it all down.
Financial freedom faster. Financial freedom faster.
If you like watching other people make money, keep scrolling. But if you're the kind of person who wants the edge, the insight before the headlines, hit subscribe. Because in 2025, more New Zealand investors get their housing intel from this show than anywhere else on YouTube. The smart ones already know, and now you do too. Kelvin, why do you think no one's talking about yields hitting decade highs while prices sit still?
Yeah, I mean, that's one thing that it does probably sneak under the radar a little bit. Property yields are back up to sort of 3.94% at the moment, which is the highest they've been for, as you say, sort of 19 years. So that is a better figure. I guess, there's so many moving parts for the investment decision, though, isn't there, that, the costs have gone up in the meantime. Rates are high. Arguably, you might need a higher yield to compensate for higher costs than we might have had in the past. And also, the yields are averages, and so we look at an average rent and average property value. Now, the average property investor might be able to get a higher than average rent, and they might pay less than the average for the property. So, the average yield that we look, and we have to look at averages. It's just something we have to do as economists and analysts. But the average might not really apply to too many people. Investors will do individual deals with individual rents and individual values, and they might actually be able to outperform those yields or underperform for that matter, actually. So yeah, I think it probably does sneak under the radar a little bit. Partly I'd point to perhaps higher costs than what we've had in the meantime, which makes those yields not look as impressive as they might otherwise do. And also, maybe on the ground, individual investors don't pay too much attention to it either, because they know that an individual deal probably won't have the average yield, and they can drive things a bit harder for those individual properties. So, but yeah, it is. It's helping. Rental yields are up. But as I say, and I think the bigger factor has probably been that interest rates come down. So the big thing that's closed that top-up gap is not a rise in yields; it's the fall in mortgage rates. So that's really a big factor too. And I suppose just one other thing on that is that rental growth is just a little bit hard to achieve at the moment. In terms of, so rental yields is one thing, but rents themselves, and trying to push through rent increases, that's just seems a bit tricky at the moment. Very hard to get so-called good tenants from all those surveys that's saying it's quite hard to find tenants from a landlord's perspective. And also there's other pressures out there. Net migration slowed down a lot. There's a lot of rental listings on the market, so a lot of choice for tenants, and rents are already high. Part of that increase in yields, of course, has been rental growth. And if you also look at the level of rents in relation to household incomes, that's pretty much at a record high. So it is just going to be difficult for tenants to keep stretching in terms of paying higher rents. And we've seen in the past that rental growth is driven more by tenant affordability than landlords' costs. So in a situation where rents are already very high in relation to household incomes, it's going to be pretty tricky to keep pushing those rent increases through. So I guess from an investment perspective, there's pros at the moment: lower interest rates, smaller tax bills, these sorts of things. But it's never one-way traffic, is it? There's always something that a wee bit of a fly in the ointment. And at the moment, that is just the rental market itself. Rents have gone flat. So yeah, all of these things people need to be sort of factoring into their decisions.
Well, based on the data from your recent report, I saw that interest-only lending has been trending down. So despite what the numbers are saying about the yields being up, the way that the investor usually works is with some leverage. And if they're not using interest-only lending, are they really actually getting that cash flow benefit? I guess the question is this rent-to-value landscape, where is the best spread that you're seeing at the moment?
So I guess the interest only lending, I guess, starting with that, you're never quite sure, I suppose, whether it's supply driven or demand driven, in the sense that have banks just pulled back a little bit on the amount of interest only lending they actually want to write, is that part of it? Or have people also at an individual borrower level decided, I'd rather pay down some principal, if if my capital gains aren't quite as strong as they've been in the past, we've seen property values go pretty flat in the past couple of years. Maybe they're thinking, okay, well, how do I get return here? If I'm topping up, maybe I also try and pay down some principal as well because those capital gains aren't coming through. So, yeah, a little bit hard to disentangle all of that, whether it's sort of availability of interest only lending, whether it's different attitudes from borrowers, all a little bit hard to disentangle. I guess around the interest only point, one thing that's been talked about is that maybe in this environment where people, there have been some job losses, no doubt about that. In this environment, perhaps people would have gone interest only to give themselves a bit of breathing space on repayments and that cash flow side of things. But we haven't really seen it. So the fact that interest only lending is still relatively controlled, I think, just fits with a whole bunch of other indicators we're seeing, suggesting that yes, it's been tough for people. I mean, paying their mortgage is not easy when interest rates are 7 or 7.5%, but most people have got through. They haven't needed to switch interest only. We're not seeing mortgagee sales. We're not seeing non-performing loans at the banks. So, there's lots of different ways, I guess, you can look at the interest only lending and what you take out of it in terms of your conclusions. But one thing and one aspect that people have looked at is taking a bit of comfort in the sense that, we're not seeing people switch interest only due to sort of financial strains. So that probably should be viewed as a good thing. Now, there's other angles as well. From an investment perspective, obviously going interest only helps your cash flow. So that's another angle that people would look at there. But just right now, it is part of that whole lending environment that does seem relatively controlled, relatively sort of restrained.
And what does the data about the rental demand say with regards to rents went up 10% in 2021, now they've come back down? Is this net migration problem just holding back the rents hitting that peak again?
Yeah, we certainly saw a rental boom when net migration was very high, just post-COVID there when the borders reopened. We saw a big rise in rents, lots of people coming into the country. There wasn't a lot of rental properties available. Part of that was, I think, because of the rules that worked against property investors, where we weren't seeing as many new rental properties come forward because investors weren't as active as they normally would be. So we saw a lot of people coming into the country. We saw, perhaps slightly restrained supply growth in terms of rental properties coming forward to the market. So, no surprises. Rents went up a lot. Now, there's a natural tendency there for migration to affect rents anyway, because if you think about a typical new migrant to a country, I've been a migrant. I lived overseas for a long time. Of course, I rented. It gives you that flexibility. You tend to go into the rental sector for a start, and of course, think about people coming to New Zealand. It's not only that natural tendency to rent for a start, but also the foreign buyer ban. If you don't have a residency visa or citizenship, well, you're not going to be able to buy a property anyway unless you're Australian or Singaporean. So, generally most new migrants to the country would be renting for a number of reasons. So we saw that migration boom go into the rental sector. But of course, now those things have flipped right around. We've seen net migration really tail off a lot. It's still positive, but it's definitely not as strong as it was, and it's below average. I think that's the main point there. And then, a lot of rental supply has increased. So, investors coming back to the market again. We've seen, I guess, it's hard to prove with data, but anecdotally, that a lot of those developers for new townhouses, certainly around Auckland and other parts of the country too, might have wanted to sell those properties when they're finished, but haven't been able to, or perhaps weren't confident of the price they'd get. So they've pushed them into the rental sector. So we've seen a number of reasons why that supply of rental property has risen quite a bit. So demand growth slowed down. Supply growth has increased. Lo and behold, we've seen rents go pretty flat. And of course, then that point that the level of rents is already very high in relation to income. So there's an affordability challenge there for tenants. So supply and demand, and also simply where we're starting from for rents is restraining that growth.
And based on the political environment moving over the next 18 months and with the potential that OCR doesn't drop, what tends to happen in a market for the property values when there is uncertainty and when there's potential political change?
Yeah, I mean, people probably put forward a couple of views on this as well. I think there is a case for a sort of safe haven argument for property. I mean, it's the bricks and mortar thing. Everybody trusts property in an uncertain global environment, particularly what we've seen in the past few days. People think, okay, yep, I wouldn't mind having a bit of solid ground to invest in. I think that's part of the story around property. But of course, global uncertainty, global risks, all of that changes day to day, hour to hour, minute to minute. The decision to invest in property is not not an overnight thing. It's going to take you some time. So it's a little bit difficult to run that safe haven argument too strongly, I think. I mean, I'd probably just point to the other side of the equation, I guess, which is, global uncertainty, tariffs, all of that is going to be a net negative for a small exporting country like New Zealand in terms of our economic growth. We're already seeing a pretty weak economy and pretty weak labour market, which I think is playing out in terms of restraining the housing market. So, if anything, all of this stuff going on is probably just going to support that situation or just reinforce it. And then at the same time, there's the inflation risk. So we are seeing some more inflation come through in the system, food, household energy, that sort of thing. You'd wonder about oil prices in this new sort of conflict that's broken out. So a subdued economy at the same time, possibly some inflation risk. You would think that we're perhaps going to get less sort of interest rate relief than we otherwise might have had, because yes, the Reserve Bank would like to support the economy, but if inflation's rising, that's their number one target. That's what they have to look at. And if inflation's rising, then perhaps we don't see the same scale of OCR cuts that we might have seen. So I think these are all at the margins, I guess. I don't think this dramatically transforms the housing market outlook, but I just think in this environment where uncertainty is high, inflation is a problem, the economy is still pretty weak, I think it just adds to that case for expecting a relatively cautious housing market outlook. And yes, there could be some safe haven demand for property, but I think that's a bit of a slow burner. It's hard to react overnight. You can't just go and buy a house overnight. So there is I think that you could probably go too far with that side of the argument.
Well, I appreciate your insights today, Kelvin. Where should people go if they want to read your totality report?
Well, unfortunately, our website is still www.corelogic.co.nz, but that's about to switch in the next week or two. So either Google CoreLogic or Cotality, and you'll find all of our stuff there. And in a couple of weeks' time, it should be all Cotality. So hopefully everyone can navigate to that.
Appreciate your insights, Kelvin. Look forward to chatting again soon. Just a reminder, your competition has already hit subscribe on the fastest growing property and investment channel in New Zealand. They're getting the tips, the tricks, and the juicy insights before you've even finished your coffee. They're buying, building, and banking profits while you're still sitting there thinking, should I click a button? Come on, be clever, hit subscribe, or don't, and enjoy watching everyone else get rich.